I call this methodology the fund manager method. I came up with a cheesy name for it because that's what you do when you come up with a method. And we'll jump into that right now. I'll share my screen. Trading is actually a pretty simple game at a very high level. Most people don't think about it correctly, but once you realize it, it's a game of buying cheap things and selling expensive things. Imagine someone offered you $20 for a $10 bill. You're holding a $10 bill and they say, I'll give you 20 bucks for it. What do? Right? You say, sure, no problem. Easy, right? Free $10. In the same way, if we see an option that's trading for $20, that's really worth $10, it's easy to make money. The hard part is figuring out what something's actually worth. That's the actual skill of trading, is learning how to price these assets and figure out where things are mispriced. Once you're able to do that effectively, making money is not very difficult. And that's what we get paid for. We get paid for that analysis. And there's a number of different reasons why something might be mispriced. Someone might just be willing to overpay for something. For example, around an earnings event, pension funds hold a bunch of Apple stock. They want to hedge their downside risk because, a 10% down move in Apple would be devastating to their investors. So they're willing to pay for a put option, and they don't really care if it's $2 or $3. But as volatility traders, we come in and we price it, and we say, no, this $3 option is really worth $2. So we're going to go and sell those to them. And if we do that across enough different trades, even though some of them will move that $10 and we'll take a big loss, those premiums we collect along the way will compensate us more than the blows that we take when we do have to pay out. And that's something to really think about, because the fact that we have to pay out those times is the reason people buy insurance, right? If no car crashes ever happened, nobody's buying car insurance, except for the fact the government enforces it. But besides that, nobody would actually buy it if there wasn't the risk of the car crash and having to replace your car. So in the same way, even though along our journey, we will take losses, it's not something to be weary of. It's actually to be expected, because taking on that risk is the reason we get paid in the long run. So now on to this methodology. Okay, so I called it the fund manager methodology. And basically what I did was I created an almost scientific approach to pricing volatility and finding profitable trades. It's actually quite similar to a scientific method in the sense that the way we think about every trade idea we come across when we're doing this method is it's just a hypothesis. It's something that we need to test. We have a theory. From there, the rest of the methodology is steps that we follow to validate our idea. If the idea passes our validation, we can take the trade. And if it doesn't, we move on, we look for another. An idea is considered valid when it meets two criteria. Number one, there is a gap between the current market pricing and our opinion on the fair value of that option. And number two, there is a logical reason why this gap exists. If we see something that looks mispriced, but we can't actually understand why, then we can't take the trade, because sometimes it's mispriced for a reason. For example, insider trading. That's like the most obvious one. You see call options through the roof expensive on some small biotech stock, and you think, oh, easy sell. But little do you know that there's someone who knows that they're going to release some news in the next week that's going to make the stock go up 500%. If we don't understand why something is expensive, we can't be taking the trade. Now, I'll be linking this document to you over the next week. I'm just going to format it, make it look all pretty for you. It has a couple of more video lessons and trade examples to go along with it. But before we go over trade examples, which we're going to do in this video or in this webinar, I want to go over the steps with you. So we're going to go through this pretty slowly because each step is important. And we move from 1 to 2 to 3 to 4 and so on. We don't skip any steps. And I'll actually show you a document I created for the trades we're going to go over, where I literally just followed these steps. And I hope that by the end of it, it'll make a lot of sense and totally change the way you think about trading. Okay. Now you can apply this methodology to all sorts of different trades, but for the basis of this webinar, we're going to assume that we're looking for expensive options. Okay. So step one is to create a watch list, a list of stocks that we want to look at. Now, the way most people do it is they'll go out and they'll just think about the tickers that they know or that they see people talking about. But You have the PA terminal. You don't need to just rely on your eyes and ears to figure things out. You can use data to your advantage here. So what I recommend doing as a basis to start from is use the scanner in the PA terminal and run the scan for expensive option premiums. If we hop over to the terminal quickly, right? I'm just on the volatility dashboard here. It's the page you log into. We have a list of different strategy filters here. Right here is the expensive option premiums. You click that, and this repopulates with all the tickers that we could be considering. Once we have our list, we need to click on each of these stocks in the list, right? When we go back over here, if we click on a stock, look at this up here, I click on TBT, the page will now repopulate with data for TBT. Now, we have a list. And what we want to do with this list is we want to whittle down that list to less stocks, right? Off the bat, we can disqualify some of them. Let's say we look at TLT or some other stock. TLT is not a good example, but another stock, and it's in a buyout. Another company's buying it. Instantly, not something we look at anymore. If something has low option volume, meaning it's going to be really hard to actually get in and out of a trade, well, that's going to cost us a lot of money. We probably don't want to look at those either. So low option volume, disqualified. Or if the thing doesn't really move, if the market doesn't think it's ever going to move, if it's not actually moving at all, we have no use for it. So if implied or realized volatility is less than 20%, move on. Now for the remaining stocks, step 3, we have to decide whether or not we want to include upcoming events. Remember, volatility is pricing what's going to happen in the future. If we're looking for expensive options over, let's say, the next 30 to 60 days, do we want there to be an earnings event in the mix? Well, maybe, maybe not. It just adds another component to the trade. So let's say the answer is no. I want to keep it simple, no earnings events. All you do is you go to the event filter in the terminal and you change it to no. Event means earnings event in this case. So what you do is you come over to the filter here, right, on the scanner, and it's not normally on the table, right? You see, there's nothing that says event. You come over to metrics here and you click event, right? There we go. There we go. Now you can see if we go here, we have the event column. So let's say I don't want to see any ones with earnings events. I just need to check to make sure that it says no. If you want to avoid other stocks with major events, my recommendation is avoid pharma stocks, right? Any of these biotechs where a lot of their movement is driven by events. Hey, we got this clinical trial approval. Hey, we've released this new technology. Just avoid those for the time being. There's lots of trades you can take around them, but for the purposes of this, we're going to disqualify them. So now we have a list, right? Anything that's we should disqualify, we're not going to consider. Anything with events, we're not going to consider. But everything else is pretty fair game. And now this is where it's going to get a little bit tedious. Now we got to do the real work. And that is doing our analysis. Each of these other stocks on the list is fair game for us to analyze, right? And basically we're going to go stock by stock with the hypothesis now that options on XYZ stock, whichever one, are looking expensive. Something that I'm going to do just because of the current market volatility and the way things have been going is I'm actually going to only look at stocks, meaning I'm not going to look at ETFs for this analysis. So the way I do it is I come over to metrics and I pick type, and you can see type has ETFs here, but I only want stocks, so I just change it to stock. But before I do that, I'm going to add a couple more metrics on here, I think, just for our analysis. I'm going to add industry so we can see the industry of different assets. So if I scroll over, we can now see like what industry things are. So let's take off the ETFs, or actually I'm going to add forecast of volatility as well. So you see how I'm just like adding whatever tickers I want on here, or columns. And now I come here, let's do stocks. Right, we can see different industries over here, and we have 76 potential tickers we can look at, all fitting our initial hypothesis that the options look expensive. Up next, so now we have our list, we have our hypothesis. Here's the analysis. There are 3 things we're going to do. Number 1 is we're going to look at the news and say, is there a reason that options and volatility would be overpriced here? You know, maybe there's a product release that came out. Maybe there's some pending news, good or bad. There might be industry concerns, supply chain issues, increased retail trader activity, or maybe some bad press coverage. You know, CEO got in trouble for something like that might have happened. All of these are reasons that can create uncertainty in the market. And uncertainty is what drives volatility. Once we do our news analysis, we're going to actually dive into the data because now we have a logical reason. It's like, oh, this is expensive because of this reason. Cool. Now let's actually try and figure out how overpriced or mispriced might this thing be. And there's two ways we're going to do it. Number one is, I call it an absolute valuation. This basically means we're going to compare how the stock is trading right now to the past. Is it trading higher or lower than what's happened in the past? The second way is, after we do that, I call it a relative value comparison. We're going to say, okay, this thing does look expensive. How's it trading relative to similar stocks? Stocks that are correlated with this one. Because if two things are correlated, they should be trading similarly. They should move similarly. So if things are supposed to move like this, but all of a sudden this one goes like this, that's a signal that this one might be overpriced. If our analysis meets these three criteria, there's a reason it should be overpriced. It's expensive relative to the past, and it's expensive relative to similar companies, we have a good trade on our hands, right? All of the criteria for why this thing should be trading at a different price, why it's trading higher than it should be, are now met. So what we do is we state our expected outcome, and then we structure and place our trade, right? And what this is going to be, this might be a little bit of a tricky part, but it's so valuable. We're going to use all the information we gathered up here to say, what should this thing actually be trading at? We're going to create our own opinion on what implied volatility should be. And then we're going to use one of the calculators in the terminal to calculate what our expected profit should be if we are correct. Once we do that, we come and put on our trade, and we do what's called a stress. And what that means is we put the trade on, we look at it on our brokerage, and we ask ourselves questions. What happens if the stock moves 10%? What's the worst case scenario? When do I take losses? When do I take profits? We answer all these questions. Once we've done that, all that's left to do is put on the trade and monitor it according to the analysis that we did. We've done all the work now. All the work happens before you place the trade. So what we're going to do now is we're going to look at some real-time examples of using this methodology, because I really want you to be able to internalize this process. It utilizes all the functionality of the terminal. And I promise you, if you internalize this and thoroughly understand what's going on, you're going to find amazing trades. It's really that simple. No matter where you generate an idea, if it's from the scanner, if it's something you saw go crazy in the news, you'll actually be able to price it. So let's do an example here. Let's start off with the general idea, right? We came in here, we did our expensive option premium scan. We added the extra columns that we wanted, right? I wanted to have the industry on here just so I can check that. I wanted to have the forecast on here. I wanted to have the type on here because I don't want to look at ETFs right now. So I just put stocks. And now I pretty much just went through the list. I went stock by stock. So the first thing I found was actually a trade on BHP. So it was on the second page here. I got down here to BHP. And I clicked on it. Right? So now we've loaded the data for BHP. And if we go back to the fund manager method here, within each of these steps, we actually have some tips and tricks of things that we can look at to do this pricing, right? The absolute value, it's like, here's a bunch of questions we can ask. So let's go through them for each of these trades. So first up is BHP. I basically pulled it up and I was like, oh, cool. What's going on here? You know, quick glance for me. I was like, oh, cool. Look at this spread between implied and realized volatility. Well, that's something I usually like to see. Okay, let's dig a little bit deeper into it. I did a quick scan. I looked at my brokerage first, actually. I'll pull that up over here. And I was looking at BHP and I was looking at some of the news. So I saw some like positive and negative news kind of going on here, you know, about some changes in the industry that might impact it. If we come down here and we look, you know, BHP took a pretty big hit back in August, right? And whenever stocks, the thing to understand about volatility is, remember, volatility measures how much something is moving. So if something drops a ton, volatility usually goes up. Implied volatility goes up, realized volatility goes up. And that's pretty much what we saw here, right? If we look over here, right, we see like start of September. Over here, it's like start of September. We see this huge drop. Implied volatility goes to the roof, right? Goes up to the moon. But after we saw this huge drop, it just started chopping around again. And that's why we see, if we zoom in a bit, we see, realized volatility start to taper off a bit, down from 35 to 32. But implied volatility is staying up. So this is pretty cool. It's like, okay, stock took a big hit, not a ton of news around it, but some positive, some negative. Okay, realistically, the news side of it could be a little bit stronger. But overall, there's a pretty significant risk premium that we're seeing here. And I thought it was worth digging into a bit more. So once we've done that, go back over here to the fund manager method. Right? Let's say we've now passed the news analysis, right? Now we need to say, okay, let's compare it to the past, right? So the first question we want to ask is, how high is implied volatility relative to realized volatility? And that's what we use this graph for here, right? And if we look, right, I've zoomed in for, basically August till now, and we can see that implied volatility has been rising, and so has realized, but implied has been outpacing it, meaning the option prices have been overstating how much movement we actually see for the stock. And so for the first question, okay, we got a check mark. Implied volatility is higher than realized. Great. Second question I ask is, how high is the premium rank, which is the ratio of the implied and realized? Now, I usually like to see a pretty significant spread. It basically measures the spread. And that's just a number here in the terminal, right? We go up, key metrics. Right here, we have the premium, IV-RV30, and it's at 1.33. That's a pretty high premium, right? We'll see later in the analysis, that's actually near how high it ever gets for this stock. So that's a really good signal for me. Next up, I like to compare what the IV versus forecast is, right? Remember, this is one of the most valuable parts of the terminal is you actually have access to a statistical forecast of volatility, right? If we remove all the noise and we just say, looking at the data, what should volatility be at? That's what that forecast number tells you. I usually like to see it in the 1.15 to 1.2 range. If we look here, right, we have BHP, IV-FV30. It's at 1.3. Implied volatility is at 42.95, and the forecast is at 32.75. That's a huge spread, and that's a really good signal for me, right? So we've gone through these three questions here so far. Next up, is the stock currently implying more volatility than it's realizing? Just today, right now, is it still overstating it? To compare that, we use these two numbers right here, right? The realized volatility of today is literally the price change. And what we've done here is we actually have the one-day implied move in percent of the stock. And we see it's 2.89%, right? So market's saying this thing will move close to 3%. It actually moved 2%. Perfect. Great. So we have another green light here. How are options being priced relative to historic levels? So what I want to do here is, okay, cool. Short term, it's been pretty good. Looks like a good risk premium, implying more than it's moving. But what about just like over the last year? Are we like seeing implied volatility actually being high? Or is implied volatility really low and there's a good chance that it could jump a lot still? Well, to do that, I just come over here to the vol cone, right? This volatility surface, volatility cone, this chart right here. This basically tells us for each of the different expirations, here's the highest and lowest for each of the expirations that implied volatility has been. Here's where it currently is. So we can see, especially around these nearer dated options and the really far dated ones, we're pretty close to the highs. We're 5 points away from how high we've seen it be over the last year, right? And, last year has been pretty rough. So this is a good measure of how high things likely are to get. So I'm pretty happy to see this near the top as well. Things are just sort of looking expensive relative to the past. You see how I'm kind of fitting things together here, painting a picture, right? All I'm doing here is every little piece, I'm adding it to the picture, trying to figure out, is this thing actually expensive or not? And so far, things are looking pretty good, right? So we'll bold this one as well. We're doing good. How much activity is there around the stock? So basically, I want to see, are things actually trading here? Like, are people buying calls and puts? Like, what's going on? How many calls versus how many puts? Does it maybe, if we had really strong news, we'd want to see, does the put and call buying match the sentiment that we're seeing? But with the sentiment being sort of in the middle, I'd expect to see things be pretty relatively even. And so let's zoom in on the last little bit, right? This is the option volume chart I'm looking at here. So all I did was change from the volatility chart over to the option chart. And then I zoomed in on the last 2 months or so. And yeah, things look pretty good, right? You know, if we zoom out a little bit more, it's pretty normal volume. Like this, we haven't seen any major changes. So all's good. Right? So I wouldn't say this is like a super strong signal on this one. It sort of is just it's not a disqualifying signal by any means. And then finally, I'd like to look at the skew graph, which tells us the pricing of calls and puts relative to each other. It informs us about where the market thinks the risk is, where the market thinks the most likely move is. If you're not familiar with those concepts, it's in the silver education. And basically, I come over here, I can look at skew. It's under the price chart here. This is how skew has changed over time. We've seen the last little bit, skews come down, you know, actually quite a bit. But overall, skew is where it sort of should be, right? On equities, remember, volatility goes up as assets go down. And that means, and the most likely thing is that stocks go up. So the risk most of the time is to the downside. So seeing some put skew, which is what we see when this number is higher, right? The zero line would be even, right? Seeing it on the upside of this, there's no surprise here. There's nothing out of whack. The skew is sort of just where it should be. Perfect. That's fine. So that's cool. So at this point, we have a decent understanding of whether or not the inefficiency is tradable. To a degree, we could probably stop here and place the trade. But, you know what they say about making assumptions, right? Maybe we should dig a little bit deeper and be as certain as we possibly could be. Remember, as much as trading can be fun and stuff, we are putting our money behind these ideas. The better our analysis, the more money we make. The worse our analysis, you know the answer to that one. We want to avoid that. So, quick pit stop. Let's look at our checklist based on this first part of the analysis. Is there a news or sentiment-based reason why the options should be expensive? Sort of. There's a bit of uncertainty around the stock. Some buyouts fell through. It had a really big drop in price recently, which is causing the implied vol to go up. So that's a decent reason, sentiment-wise, right? The news isn't really there, but the sentiment seems to be that there's more risk associated with this stock now. It is a really big stock, by the way, as well. So it's not like, it's unlikely that this thing goes to zero. You know what I mean? Okay, so we'll give it a check mark there. Is implied volatility higher than realized? Yes. Is the premium rank higher than average? Yeah. Is the IV versus FV ratio greater than 1? Yep. Are any expirations greater than the average implied volatility on the volatility cone? Come back down. Right, put the median on here. Yeah, they all are. Perfect. Right, we're seeing some pretty high relative to the past implied volatility. Does the put and call trading volume match the sentiment we see? To a degree, this is sort of a weak signal. I wouldn't say a yes to this one. And does the skew match the sentiment we see? To a degree, I probably wouldn't give this a yes either. So we have some yeses and some nos, but as a general guideline, if the answer is yes to 4 or more of the questions above, we can move on. And we see we have a yes for 1, 2, 3, 4, 5. All right, let's keep moving. So things look expensive relative to the past, right? What do we do now? Well, up next is this relative value comparison. What we want to do is we want to take our target stock, BHP, and we want to find similar companies and then look at how the options are trading for those two companies and see if there's any discrepancies that are not normal. Because we can use that to say, well, is this something that's happening in the industry where all stocks are being impacted? Or are we actually seeing an inefficiency specific to the stock that we're looking at? Lucky for us, we have a very cool page here in the terminal called the correlation page. This page will literally allow us with the click of a button to find similar companies, correlated companies. All we have to do is this. We use the correlation finder here. We come in and we select BHP. Done. Click start. Here are 3 companies correlated to BHP. They share the same industry. They share the same sector. We can see whether there's an event or not. We can see how big the market cap is. And we can see how strong the correlation is. So check this out. We can see that there's 3 companies listed here. 2 of them have events, but also lucky for us, one that doesn't have an event is actually the most correlated one, which is RIO, right? Same industry, same sector, same size-ish company, no event, and a 0.91% correlation. A very, very strong correlation, right? Closer to 1, the more strong the correlation. Right? Correlation meaning basically how similarly do they move to one another. Cool. So if we go back to the fund manager method, step 1 in our relative value is find those correlated companies. Okay, we basically did that. Now we're going to go over to the relative value page. And this is the page that we're going to use to compare the 2 companies. So we come over to the relative value page. It's right here under trade analysis. And the way you can think about this page is like this. That premium rank, you remember the premium rank that we saw here? Right, this number here. You see how it says IVRV30 in here? What this means is that premium is the implied volatility 30-day divided by the realized volatility 30-day. That's how we're getting that premium metric. And what we can actually do is recreate that in the relative value page, but actually see the historic ones as well. And we can do that for both companies at the same time and compare them. And that's how we're going to measure the risk premium of both against each other and how similar those spreads move to one another. So let's go back over to relative value. Check this out. So this side here is for 1 ticker. Okay, let's put this as number 1. And this side here is for a 2nd ticker. Meaning, we're going to put 1 value in here. We're going to put 1 value in here. It's going to create a ratio for us. And when we scroll down, we'll be able to see it. We're going to do the same thing over here. And when we scroll down, we'll be able to see the line for that one as well. So let's go ahead and do that. So our target stock is BHP. So we're going to make that spread number 1. So let's put in BHP here. And for the comparison factor, I want the top one to be the IV 30-day. And for the bottom one, I want it to be the RV 30-day. So I just typed in RV, hit the 30-day, and I'm going to turn on the spread factor. We're going to do the same thing on this side, turn them all on. But for this one, we're going to use our comparison stock, which is RIO, R-I-O. Right, we put in RIO here. We already have IV30 up here. We'll put the RV30 on here. Now we're going to click start and see what happens. Okay, so we got some graphs populated. The one we're most interested in is this spreads time series. This first spread. You see how this number here at the end, you see how this is 1.33? Does it look familiar? Come back over here, Vol Insights, premium 1.33. That's how we're getting that number. So we can see how that number has changed in the past. This is where that ratio has been in the past, right? Right now, you can see, if you look closely at the white line that appears, right? You see the white line going horizontally there? You can see we're getting pretty close to the top. That's a good sign. But what we're interested in now is how it compares to this second spread, which is for RIO. If we put both of them at the same time, check it out. If we zoom in, they move very similarly to one another. Occasionally they come apart and then they come back together, right? We see these long periods where they trade almost identical to each other. The premium on both is almost identical. And it makes sense because if one stock moves a ton, the other one should as well, right? Makes sense. By the way, for these points down here, occasionally we get some bad data, right? When you see these crazy like 1-day drops and stuff, just ignore those. Look at the trend, look at the overall picture when you're doing this part. So let's zoom in here on the last little while. Now, something, by the way, I just want to point out that I noticed about these 2 stocks is when they do break apart, a lot of the time, RIO is actually above the spread for BHP. Just something I noticed. Nothing super scientific about it. Just thought I'd point it out. Let's zoom in here a bit. we take a look for the last month or so, they've been trading pretty close together. If we zoom in a bit more, look at this. We actually see that in the last 5 days, 6 days, the spread between the two has gone from exactly the same, basically, to BHP's spread being at 1.33 and RIO's spread being at 1.16. Meaning, you notice how this is actually correlated. We see that change in implied volatility over here. Right, we come back down, go to the implied volatility chart. Right, we see that implied vol running up here with no change in the realized volatility. Right, this spread here, I can just draw. Right, this spread is getting bigger. That is that premium spread. The difference between the two is the premium we can collect. So this is a great sign, right? This is a great sign that we have here. Okay, so let's go back over to the relative value page here, and let's actually check out our document here, right? You see how we're just following this process. It's a checklist. We're moving through it. We're thinking through our thoughts, and we're putting together a really nice picture of what's happening around this stock, right? So we basically did these steps, right? We put together our spread. We come down here, we look at the spread's time series. You should see that historically the spread for the companies is correlated, right? We do see that. Is there a break? Yes. With our target stocks ratio going higher than the correlated one? Yep. If yes, that's a great signal. Perfect. Now we only have one stock we're doing a comparison with, but if you had others you wanted to add to the mix, you want to keep doing it, and you want to see that break, that little spread change for at least 50% of our comparisons as like just a rough benchmark. That's the whole relative value. We've now done our 3 comparisons. We looked at the news, we looked at the sentiment, we looked at it relative to the past, and now we've looked at it relative to similar correlated companies. In all 3 of those situations, we are able to understand why we are seeing this mispricing on BHP. So checkpoint number 2, focus on the relative value stuff. Is there a relationship between the IV-RV spread for our target stock and the IV-RV spread for our correlated asset? Yes, we see the relationship. Do we see the recent spread break away from our correlated stock spread at least 50% of the time? Once again, the answer is yes. If the answer is yes to these 2 questions, we can be confident that the inefficiency we're seeing is unique to our target stock, and we can now continue in our process. Step 7, we're basically there. This is the home run. This is the home stretch. State our expected outcomes, structure, and place our trade. Now, this part is a little bit tricky, but I really encourage you to not skip this step. It's this step that allows you to manage your position correctly, because this is the step where we're going to calculate our expected return for the trade. How much are we expected to make if we are correct? The first thing we need to do is pick what strikes and expirations we think are overpriced. For the expiration, select the one that we think or stated was most expensive in our analysis. And for strikes, typically we'll be trading at the money. But if we see something wrong with the skew, we can maybe trade that. Right, so we go back over to the terminal here, come over to vol insights. Right, we looked at the skew before, right? We're on the skew graph right here. It looks pretty normal. So I'm not really concerned about skew here at all. At the money, it's going to be, meaning we're going to trade options that are closest to the current stock price. Now, for picking our expiration, I'm going to use this volatility cone. Now, the expiration that looks most expensive is these roughly 30-day options, right? We can see they're the most elevated relative to their norm. And typically with trades like this, I do like to look around the 30 to 60-day mark. So it fits pretty well with what I'm trying to do here. So we'll go with the 30-day options at the money, or as close to that as we can get. Okay, so we're looking at these 30 DTE options. We know it's going to be at the money. If we go into our brokerage, we can literally price out the straddle right now, right? So let's go here. I'll go to BHP. Okay, we're on BHP. I'm using Thinkorswim for this demonstration. And if we look, we don't really have any 30 DTE options, but we do have 38 DTE. It's the closest we can get. It's the November 18th monthly expiry. And we see that the stock is trading at about $50. Okay, cool. So what we would be trading is this $50 short straddle. You can do an iron fly as well, or an iron condor. I prefer to just do the naked straddle and size my trade a bit smaller, because buying the wings gives up a bit of edge. There's education on this in the, I think it's in the bronze education, a little bit in the silver as well. Then we can analyze our trade, right? And we can see here what the market's implying the price of this to be right now is about $5.40, $5.50, something in that range. Yeah, so that's the market price right now. But what we need to come up with is, what do we think it's actually worth? If I sell it for $5.50 today, when do I buy it back? Right? Do I buy it back at zero? Maybe, that'd be great. I'd love to make that whole $5. But what do we actually think it's worth, right? This thing is not actually worth $0. What should it be trading at? That's what we're going to calculate now. And to do that, we are going to use all the data we gathered so far and summarize it. We're going to look at three things. We're going to compare where the implied volatility was in the past. That'll be one, right? Where should it, if it was to return to previous levels, where should it be? We're going to compare what implied volatility should go to if we want that spread to close from our relative value analysis, right? We saw the spread was big. We want that spread to close. What needs to happen to implied volatility? And then number three is we're going to look at our forecast of volatility from the data, from the terminal. Once we get those three numbers, we're going to take the average of them, and then we're going to do something really cool with one of the calculators in the terminal. So let's take a look here. All right, we're looking at BHP, right? If implied volatility comes down, to something reasonable, you think it would probably come closer to in line with the realized volatility, right? Stock's not realizing that much volatility. We don't think it should be this high. Where does it come back down to? Maybe it comes down like 7, 8, 9 points here, right? Maybe it comes down closer to this 32, 33 mark. It was there, a week or two ago. Maybe it comes back down. So what we'll use is, it's a little bit of an estimate, but we're basing it on some data here. Let's give it a number of 33% for this demonstration. We say that implied volatility, or you know what? We'll use 35% as our number. So you want to just write that number down somewhere, 35%. Where can I put it? I'll put it at the bottom of this document here. We'll call it old IV. It's not really what we should call it, but just to keep moving here. We're putting 35%. Cool. Next up, what's our forecast? Right, for BHP, the forecast is 32.75%. Cool. Forecast of volatility, 32.75%? Was that what it was? Yeah, 32.75. And then lastly, come back over to our relative value page. It's nice how it keeps the analysis you did, right? It's pretty nice. Right, we want this 1.33 to come back down to like the 1.15 kind of range. The way you do this is you basically just play around with the ratio a bit, right? We can see that the if we come back over here, right, the implied volatility is up at 42.95. The realized is down at 32.24. If I pull out a little calculator here and I do, let's say, well, let's see what happens if I plug in 37 and divide it by the realized volatility number, right? Remember that ratio is a division of implied and realized. Right, let's divide them, 32.24. So 37 instead of 42 divided by 32.24. Get about 1.15. So now I'm going to record that number. What was it, 37? Yeah. IV, RV, fix is what I'll call it. It's not really the right thing to call it, but you get the point. 37%. So now what we're going to do is I'm going to take an average of them, right? So we do 35 plus 32.75 plus 37, right? We're going to take these numbers, we're going to add them all up. And then because we have three numbers, take the average, we're going to divide them by 3. So let's do that here. 35 plus 32.75 plus 37 equals 104.75 divided by 3. We get a number of 34.9. All right, so check this out. Implied volatility is currently 42.95. So this is where we've gotten to after all of this. Market says, what was it? 42.95, was that what it was? Yeah. Market says options are worth 42.95% IV. We say it's worth 34.9% IV. Well, it's all fine and dandy to think of it in implied volatility numbers, right? We can go from here and place this trade, and as long as the stock realizes around 35% volatility, we're good. If the stock or the implied volatility comes down to that number, we're also good. Either way, if one of those two things happens, we're right. We're going to make money. But I want to actually see what my dollar return would be there. So what I'm able to do, come back to the terminal here, go to the calculator, option price. Check this out. We are able to use this calculator to figure out how much money we're going to make. We need to just fill in these variables. So for this, you're going to want to pull up your brokerage, right? And we'll go over to BHP here. And we need to just fill in the spaces here. So the first question is, what is the underlying price? AKA, what's the stock trading at right now? And the answer is 50.13. What is the strike of the option that we're trading? It's 50, right? We're going to trade the $50 strike here. Strike, 50. Expiration. Which expiration are we trading? The 18th of November. We select the 18th here. And the last thing is, what is the implied volatility percent? Well, from our analysis, we know currently they're implying about 42.95%. So plug in the 42.95 here. Let's click start. And we're trading a straddle, remember that. So check it out over here. Here's the straddle information. This box right here, there's our straddle premium. $5.53 is the estimate from the calculator. We come back over here, saying $5.42 here. Remember, markets are closed. This number, a little bit funny. There's also the spread to consider. But we can use that number here, right? So we have $5. Let's use the one from the brokerage, right? $5.42. So we'll come back over here and we'll say current straddle price, $5.42. Next up, we have, right? So, well, now we have, this is the current. All we're going to do is we're going to change the implied volatility number in our calculation to be what we think it should be, which is instead of 42.95 is 34.9. I'm going to come over here. I'm going to change this number and make it 34.9. Hit start. And you see here, the straddle price is $4.50. So we come back over. Expected straddle price is $4.50. Meaning our expected profit is the difference between the two. So using our calculator, right? This is a pretty simple one, but just to do it. 5.42 minus 4.50, 0.92. Expected profit is 92 cents per straddle. And that's assuming, with this, it's, assuming we get decent fills and that this number is accurate. It might be a little bit higher than this. This probably is going to be closer to the 550. Put us at about $1 profit per straddle. And that's assuming that things play out exactly the way we thought. It could realize a bit less and we would make a lot more money. It could realize a bit more and we lose, we don't make as much, or maybe we lose some money. But what we have done right now is we have literally gone from, oh, this thing looks expensive, to, wow, I should probably make about 92 cents per straddle, or it's like $92, $92 before commissions. right? And that is how you put together a good trade. Now, there's one more step I'm going to go over with you, and then we'll go into any questions that you have. And that is, well, I'm trading a straddle, right? If we pull this thing up here, we zoom out, right? If this thing goes to, way too high, right? If we put on one lot, like I could lose so much money if this thing goes up to, $500 or whatever. Well, here's the reality about these things. We can't be betting on that happening. That's the same thing as betting on like the lottery happening. But what we do need to do is we need to be rational and think about what is possible to happen here. What's the worst case that I should really be planning for? And the answer to that is based around looking at the implied move. Remember, we talked about this very early on in the presentation. The zero lines here. If we look, where are these zero lines? Right, if we look, right, I'm bringing this line over here. It's around about 10%. And on the downside, it's around about 10% as well. So what I like to do here is when thinking about the worst case scenario, I like to assume that the worst case will be 3 times the implied move. This thing thinks it's implying a 10% move over this range. Worst case, it's going to move 30%, right? And the odds of that happening is like 2%. It's like very low chance of it happening. But that means it does happen sometimes. We need to plan accordingly. Just because something happens infrequently doesn't mean it doesn't happen. It means it happens just infrequently. So let's up this to 30. Right, you see how the line's moving up there. And let's drop this down to minus 30% move. So right now we're looking at one straddle. For each straddle, we should assume that there's a very small chance that we lose $1,000. $1,000 per straddle. Small chance. If we're right, the max we'll make, if we hold it to expiration, this thing doesn't even move, $500. It's actually not, like, think about it. This thing moves 30%, we're losing 2 times our max potential gain. It's really not that bad. On the flip side though, right, what we actually should expect to make, right, if we drop these vol numbers here, right, so this is at 48, let's drop this down to, what was it, 32, so drop it by, what, 16%. We drop this one by, what, 3%. We should probably expect to make, right, let's assume time moves forward a little bit here. How do I do that? Over here. Right, let's say this happens in like the course of a week or something. Realistically, we'll make about 170 to 200 bucks, something in that range. And think about what we've done here, right? If we get to this point where implied volatility drops or the stock just doesn't move much and the stock is now priced accordingly to what we think the fair value is, we get out. At the flip side, if this thing saw some huge moves, right? I'm not saying we have to wait until it gets down here. I wouldn't. That's like if there's some jump risk, meaning some crazy news comes out, this thing just rips. We should plan for that, right? Or at least have it in mind. But realistically, right, this thing's implying, a couple percent a day move. If we saw like a 5% move one day, I might be thinking to get out of this trade as well, right? The reasons for exiting, there's 2 ways to think about it. One is, does the stock start realizing more volatility than implied? If yes, there's a chance that we're wrong. The other way to think about it is a dollar, like an actual dollar stop loss. Like, okay, look, I don't want to get down to this 1,000 mark here. I'm going to do my delta hedging, right? So I'm not just going to like wait for it to go down. I'm going to delta hedge every day or every, 100 deltas. And if I'm down $300, I'm going to get out. And that is up for you to set based on your own personal risk tolerance. But based on that risk tolerance, that's how you choose how many of these to actually put on. Do you put on 1? Do you put on 2? It really depends on your account size, your risk tolerance, and one other thing is, actually, I'll get to that in the end. Account size and risk tolerance, right? And your max potential loss, right? You never want this to mean you're out of the game. This eventually will happen. Remember, we are providing insurance in a sense here. There will be car crashes. Some people will have a fender bender. Maybe that's what this is. Some people total their car. That's what this is. We got a plan that someone's going to total their car. So never put yourself in a position that if this happens, you lose. Don't do it. You got to be able to take these punches once in a while. Not going to happen often. Very, very low chance. Can't take you out of the game. So that is the way we stress our trades. And then the last thing that I want to tell you about with regards to this analysis, right? We've pretty much gone over the whole thing here. The last thing that I want to tell you about for this analysis is that there's a good chance we lose money on this trade. It happens. This is not a guaranteed thing. But always remember this. Just because a trade makes money doesn't mean it's a good trade. And just because a trade loses money doesn't mean it's a bad trade. What matters is your methodology, because today's outcome does not actually indicate where we end up in the future. The reasoning, the methodology, how we are coming to our conclusions is what will determine our long-term P&L. Are we trading with positive expected value, or are we just getting lucky? Doing research like this is how we differentiate between the two. So what I actually recommend is a trade like this, I wouldn't be betting big on. I wouldn't have a lot of money in a trade like this. But I also wouldn't only have this trade on. I would have more trades. I would be spending my time looking for opportunities like this, placing some bets here, placing some bets there, and knowing that the methodology that I'm following is supposed to make money on average. Some will lose, some will win. And I'm going to build a book of this stuff, an entire portfolio of these positions, and as I get more sophisticated, I'll try to make them uncorrelated. I might have some hedges, but in general, the core of my book is finding these types of trades and diversifying across a lot of them. Some will win, some will lose. But if my methodology is sound, my reasoning is tight, spot on, I'll make money in the long run. Now, after this call, if you do have more questions, hit us up in the Discord. There's a lot of people who follow this methodology and understand it really well. I'm there. Ian's there. Ned. There's a lot of people, even on the PA team, very well versed in this stuff. This PDF will also be available to you. So you'll actually have a checklist you can follow over and over again. Keep finding trades. Share them with the group. Get feedback. That's how you're going to win. And let's go find some trades.